Good afternoon. I'd like to start off this session. This is going to be our fourth recording, our fourth with me and Felicia, our second with all three. And again, I'm Steve Cass. I'm a New York attorney and CPA practicing tax controversy, IRS and New York State. Felicia Dixon is an enrolled agent. Patrick Wanter. But Patrick, are you a CPA or an enrolled agent?
I'm a CPA and a CTRC, just like Felicia's
Okay.
a CTRC as well. Yep.
Do you want to just, Felicia, Patrick, you want to just go briefly about your bio, what you do?
Sure, I'll start off. Just a little bit about me. I'm in the great state of Missouri, in a little bitty small farm town. I do tax controversy and resolution work for individuals all over the United States. I'm an enrolled agent, certified tax representation consultant, accredited tax advisor, and I guess the list can go on. We have an alphabet soup, right? So in that sense, I strictly do nothing but tax controversies for individuals and small businesses that find themselves, buried in a hole that they just got themselves dug into.
And I'm Patrick Wanzer. I am a CPA and a certified tax representation consultant based here in Indianapolis, and I am proudly wearing my 2026 Indiana Hoosiers National Football Championship sweatshirt as a 1995 graduate of Indiana University. Never thought Indiana would ever win a football championship, so what a thrill it was for us. But yes, I'm the owner of Breakthrough Tax Resolution. We do solely IRS and state tax resolution, tax representation. The only tax returns we prepare are back tax returns for clients. We don't do any forward compliance work for clients. I am the author of individually of 3 books: Break Free from the IRS, How to Resolve IRS Tax Debt, Reclaim Your Freedom, and then Break Free from the IRS, Taxes and Divorce, A Match Not Made in Heaven. And then my book, The Power of Why Not, Breaking Boundaries and Redefining Possibilities. And then with my good friend Felicia, we both wrote a book together called Drop the P, How to Go from Tax Prep to Tax Rep. And it's an excellent guide on people who are looking to transition out of tax preparation into tax representation. It goes through all the guides and stuff like that. So it's a great read to pick it up if it's something that you'd like. But yeah, I've been doing this for about 11 years and really enjoy doing it. I enjoy helping the clients and just keep plugging along.
Yeah, actually, I don't want to age myself, but I've been doing this over 25 years, again, as an attorney and CPA. I started off doing strictly bankruptcy, high-end Chapter 11, and tax workouts. But then somehow I got involved in tax controversy because I found out ways in bankruptcy where I could discharge taxes, including unfiled taxes and even fraudulent taxes, and actually coming up with really creative workouts with trust funds. Of course, I had friends at the high levels at the New York State Attorney General's office and Department of Justice and Special Procedures. They used to really give me great deals. But a lot of my friends retired, so right now I just do tax controversy, IRS, New York State. Occasionally, since I did do bankruptcy for a long time, I get people call me out to do out-of-court workouts for corporations or states, primarily that have tax debt, but they also have other debts. And sometimes that could get very interesting. Now, before we get started, Patrick, talking about your bio in Indianapolis, are you a Daniel Jones fan?
Daniel Jones. Oh, for the Colts. I'm sorry. I am so focused on Indiana University football this year. I really didn't follow the Colts too much. Actually, was a Daniel Jones fan. It was an unfortunate injury that he had to him, and then the season kind of got away from the Colts. But I am a fan. I think he was always a better player than I think his record showed in New York, and they're looking at bringing him back again next year. So.
Yeah, I followed his career from New York. So let's get started. I'm going to first walk everyone. So.
I don't want to interrupt, but Stephen, I'm going to age you just even more. You said you don't want to age yourself and how long you've been doing this. So if we're going to throw that out there, I started January 1st, my 47th year in business.
Wow,
That's a
very
full
impressive.
step. It's hard to believe it's been doing it that long, but yeah.
Yes, I turned 54 on Saturday, so you started when I was 7.
Happy birthday to you.
Thank you.
So I'm going to walk everyone through our agenda, which we're going to hope to accomplish in the next 45 to 50 minutes. First,
Okay.
we're going to talk about IRS passport issues. We did a video about this, I believe, a month or 2 months ago. We're going to go in a little bit more. I have a major, large case of, as an example, and some new issues, and it's pretty relevant to what people could be going through. Next, Patrick and Felicia will go into a lot more detail about their book since it's been launched. Third, Patrick primarily will talk about divorce issues, both in tax planning and also in tax resolution. Fourth, we're going to talk about what happens when you owe more than $100,000 to the IRS. Fifth, we're going to talk about payroll tax offers and compromise. Really hard to do, but we get them done. Sixth, I'm going to talk primarily about unpaid New York State sales taxes, what to do. Number 7, I'm going to talk about some various New York State issues, who qualifies for an offer, what a New York State warrant is, how to deal with it, various New York State notices, and other, main issues. And finally, we're going to conclude with different types of IRS installment agreements. So let's kick this off if everyone's ready. And we're going to talk about passports. That's, very hot topic. Now, this comes into play primarily because we all get clients that want to travel. International travel is, is necessity. It's not just a luxury. I have a lot of business clients, and they work at high-end firms, and they have to make trips for business, or they're going to lose their employment. Other times, you have people that want to, of course, travel for, entertainment, social events. Could be weddings for their family. Could be they just, have, to deal with, other family matters back then. Now, this triggers the IRS will certify under 26 USC 7345 that a taxpayer is seriously delinquent in their tax debt when they owe more than $66,000, which is, I'd say, most of my clients. Now, they certify that to the State Department. Let's talk about the process. Patrick, Felicia, do you want to get into this?
So when you're talking about certifying it to the State Department, so the taxpayer owes the threshold, they have a threshold, so they file a notice of federal tax lien against them. And when that lien is then filed, the administrative rights means that the administrative, I can't talk today, the administrative rights have lapsed, or the levy has been issued. Once they certify it to the State Department, that generally reviews or issue a new or renew a passport. And it's important for most to understand that sometimes this happens and you ignore those notices, and you need to really pay attention to your mail. If this letter comes in, and especially, Stephen, as you mentioned in the beginning, that you have a client that needs to travel. And he needs to travel not for leisure, but because it's part of what he does for a living. And if he can't travel, he may not be able to make his living. So it's important to understand that these things need to be resolved up front before that passport revocation happens.
Right, before the passport revocation happens. So once the IRS does the certification, the taxpayer has a 90-day period to rectify it before the State Department now will take action. So the IRS does the certification. We've all seen this. It's done on CP 508C. I'm sure
Yep.
you've seen a lot of these. But that is not the end of the world. That just means, hey, now you got 90 days. 90 days.
I have
This is
one in
yeah,
that
this is the
area.
important part of these notices that I think clients seem to not understand is those 90 days in this instance, or 30 days to file a 12153 after a letter 11 or something like that. Those timelines are very important. And so, you get this notice, you have 90 days, it's important to try to rectify it within that 90 days. A lot of times, Felicia, I'm sure, Stephen, I'm sure you've had this, clients come in with a stack of notices, and you open them up, and they're already past the deadline because they came,
Yes.
they came in
Right.
too
Yes.
late. And so it's important that they are reading those notices because
Yes.
those deadlines are important to
And they're
understand
stringent.
about each notice.
Those
Yes.
deadlines are very stringent.
Yes, they are very stringent. You missed the 90 days, they now will be certified to the State Department. Now they cannot travel. So, but
And
that's not the
I
end of the
found
world.
sometimes too, Pat, or Stephen, sorry, but I have found sometimes too that even though you have made connections with the IRS, this can still happen. Because I have a client that has got this issue where we have been very due diligently working with the IRS, and yet they still receive that passport revocation notice.
That's not right.
So just people, some believe though that just because they're working with the IRS that means that, oh, this is all going to go away, and that's not necessarily true.
Well,
Right.
yeah, you could be working with the IRS, but if you don't have anything set up, which, let's talk about that. You get this, you get the 90-day notice, the CP 508C. You could do, number one, call up the IRS, get into an installment agreement. Number two, file an offer. You can't just get an offer in the door next day. As we know, it takes time to do your due diligence on it and to prepare it and send off all the documents and get it into the IRS for processing. This is all done, unfortunately, by snail mail, no electronic filing, unlike bankruptcy. Third, if a really impoverished client with negative budget, you could always put them in what's called uncollectible status.
Mm-hmm.
However, well, actually, at least for the first two, for an offer or for installment agreement, and this is, I'm going to talk about this a little bit more with my case study. If you have unfiled returns, you're blocked. You cannot file an offer. You cannot enter into an installment agreement. You can, if you do qualify, though, go for CNC called uncollectible status.
Right.
So,
And so then the other thing that's important here is if for example, you owe $100,000 in tax and you get this notice and people think I have 90 days to pay the $100,000. It's not necessarily that the tax has to be paid off, like you said. If you get into an installment agreement or a resolution case the IRS accepts, then you're in good standing because they understand, okay, you may not be able to pay it in this time frame, but you've made an effort to get it resolved.
Mm-hmm.
That's correct. So let me walk everyone through with 1 minute through my case study because it's kind of interesting. It went through a lot of these issues. Client comes to me, then they got this notice, the CP 508C. What to do? They've already passed the 90-day period, so it's already being certified. I ran transcripts, which is getting all the taxpayer reports for the last 10 years, and I found out, oops, 1 year it was unfiled. So I went and I get the taxpayers, I told him to refile his return. This is old, so you can't just file it electronically anymore. He kept filing it certified mail. The IRS wasn't getting it. This was going on for months. It happened during the shutdown. The taxpayer's debt now was approaching $1 million. I called up the IRS pretty much twice a week. What to do? How do you get this return done? We're sending it to you. You're not processing it. Finally, I became, I guess, best friends with the passport control department because I was calling them weekly. They told me if I faxed the return, they would at least get it in the system as being processed. So I faxed them the return, and then they came back to me and they go, "Oops, okay, we got the return now. You're good with that. However, to do an installment agreement, your client is close to $1 million. No one at Passport Control or ACS could work that. You need a revenue officer." I said, "Okay, let's assign a revenue officer. I'm happy to work with a revenue officer." They go, "Okay, they're backlogged because of, the government shutdown and the cutbacks, 90 days. I said, "Well, my client needs to travel in a month." They go, "Well, Mr. Cass, this is all we could do." So I called up, I engaged taxpayer advocate. I kept calling ACS, became a pest 4 times a week. I kept asking for an installment agreement. And I did transcript monitoring, which we could talk about, another topic. Suddenly I noticed it showed the passport certification was reversed. Installment agreement pending was noted on his reports. I told taxpayer, said wait a week because the IRS has to now report this to the State Department. He did. He applied. He got his passport. He traveled. He got it. He's keeping his job, which he would have lost this month. And this is a taxpayer that makes a lot of money. Investment banker.
And
Close
I
to
know
million.
they definitely need to be traveling. I mean, if without that, they can't play the IRS anyway.
Well,
Right.
so the 2 points here is, first of all, it's not in the best interest of the government not to do this, because if he doesn't have the job, then they're not going to get anything, number one. And number two is how important, Stephen, it is that the extra work you did to get this client to a resolution. That it's important that you didn't just take a no and it's like, "Oh, well, I tried, guys." You took the next step. And as resolution experts, that's part of our job too, is if you get to something and it's a no, okay, well, what are the other options? Because we need to get this resolved, and you go to other people. And I just want to impress upon, the people who are listening to this, how effective Stephen's approach was, because he didn't just give up at the first roadblock.
It's also another to caveat or to add on to that is how important it is to hire a professional that understands the road that it takes and the things that are involved and the hurdles that you have to jump over in order to make this happen. So I applaud you, Stephen, for being able to get this done for this gentleman, because that's a big hurdle.
I mean, I thank you. I'm very appreciative. I mean, this was honestly a lot of work, but I feel like the taxpayer is very satisfied. I feel like I really accomplished something here. It wasn't easy. This is not the kind of work I like to do. I don't like being really on the phone with the IRS 4 times a week on one client, especially when you're quoting the client a flat fee to to get them in passport compliance. But honestly, the way I work is if I quote a flat fee, if I go over that, I double, triple that, that's on me.
True. But the other thing is, the word of mouth, you do right by the client, they pass it along, and it just builds the cash and builds the reputation too.
So the operative word, before we move on to the next topic, is never let it get to the stage that my client faced. First of all, if you can, don't let it get to that dollar amount that they're going to certify. Get your return filed, and get on a plan. Number one, file everything. Operative word, file. If you file,
so compliance.
Right. If you're compliant within the last 6 years, then we as tax practitioners have all our tool chest that we could deploy. Offers, installment agreement, maybe uncollectible status. Everything is available. Now, on the other hand, if you let it go and it grows and it grows and you get penalties and interest and no one at the IRS wants to engage with you, you're in trouble. But the point is, deal with it. So let's move on. Let's talk about your book that was launched in December.
Sure. So it's real quick backstory. In December of 24, Felicia and I were speaking at the Tax Rep Summit in Florida, and we're having lunch, and I jokingly said to her, we should write a book about transitioning to a tax representation firm, because we both did that. We both had gone from tax preparation to representation. And I came up on the spot with drop the P, how to go from tax prep to tax rep. And I meant it absolutely as a joke. I didn't think anything of it. And come January, she's like, "Hey, we're going to start on this book," and I'm like, "Sure." And sure enough, a year later, the book came to fruition. And the book, Drop the P: How to Go from Tax Prep to Tax Rep, available on Amazon.com, is a guide to kind of teach you as to why you'd want to transition to tax representation. That tax preparation is not going by the wayside, but with AI and automation, it's a much more saturated market. But tax representation requires human, review and intuition, and looking at the facts of each case and working those cases. And then we go into, okay, here's the technology that you need. We have a chapter on Ignition, a chapter on Gruntworks, on RC reports, on Lisio, on the different programs that you need, in our opinion, to really be an effective tax representation firm. Then we have a whole section on marketing, and I talk about marketing to family law attorneys and tax cure and that sort of thing. And then we kind of have a section wrapping it all up. But it's a full-scale guide on what you need to do to transition from tax preparation to tax representation. And it's and that's kind of where the industry is going, in my opinion. Felicia, would you agree with that?
I would agree with that. And everything you said about our book is absolutely true. I really think it turned out to be an amazing book, and I'm not saying that just because we wrote it, but I really do think it's a great book. But I would also say to those listeners that are still in the tax prep world and are really thriving in that industry, this book is really a good guide for them as well.
Absolutely.
So it can cross over in both directions. So even though we talk about transitioning out of tax preparation, and we say, life is too short to do another tax season, the reality of it is there are still a lot of practitioners out there that love to do tax prep. But this can give them an added advantage to how maybe to transition their tax prep practice even more so into an automated practice with the tools that we've set in place, and to add a little bit of advisory work and do some smaller representation if they're not ready to do a full-blown, let's just kill our practice and go forward. Then they can start small, and it teaches them those steps. And I know, Stephen, you use tax cures that really heavily with marketing concepts, and they are amazing. And it's things like that in the book that really sets the book out. It sets it off from a lot of other books because it's full circled.
I agree with you. I mean, everything that you said is true. I started off my career before I went to law school as a CPA, worked for a Markham firm, a couple of small practitioners, and then Deloitte & Touche. I did, on my career, hundreds, maybe thousands of returns, personal and corporate. But I didn't like it, even back in the day when I was just 22, 23 and starting off. I always thought, I needed to be a little bit more creative, wanted to do a little bit more for the clients. And that's what tax resolution enables you. It enables you to actually achieve results. Really, and you get hands-on. You feel like you're accomplishing something. Returns is important. It needs to be done, as we discussed, for compliance. Some people need to do it. The only return I do right now is my own. And I do that professionally.
And to that point, because I still do back tax return preparation. To me, back tax return prep or amending returns is a resolution case, in my opinion. So I still do that. We just don't do an ongoing tax season. But it's important. And those of you, like Felicia said, if you aren't haven't done tax representation, this book helps guide you in a way to begin to start adding it as a practice. Even if it's not something you want to do full time, you can still help your clients. If you do a return and they are going to owe money and they have a failure to pay or failure to file penalty, perhaps they're eligible for an abatement, and that's a simple task you can do, and you can then have a fee for something like that. So
and it's those little things that add up.
And so the transition, it isn't just fully going full tax rep like Felicia and I did. It is also adding the practice, but it really gives you the tools. It isn't just why you should. Here are the tools needed to really be effective.
And it also talks about, when we're talking about those advisory services that you can add to your practice, is one of them just that stands out very heavily, especially for a tax prep practice, is adding the transcript monitoring tool. So you get tax help software or Pitbull or whatever software you intend to utilize for pulling down transcripts and do transcript monitoring. This is going to give you another source of re- revenue outside of tax season. So it allows you to get that money, while you're working tax returns, and to offer another service to your clients. And it just makes you a more trusted advisor when you're sitting in front of your tax clients during tax season and working with them. Because also remember this, tax season's the number one place where a lot of clients come in, and that's when you find out they have bigger issues than just that current year filing. And
Yes.
that there begins the what do you do from here? And instead of pushing them off to somebody else, which, don't get us wrong, the three of us would love to have those clients, right? But what
Right.
we'd also like to do is to tell those out there that aren't doing this that they have the tools to do it, and getting the knowledge base. Again, we talk about TRN and having that as part of your knowledge base, and being able to reach out and touch people that do know how to do it.
I have to admit that, I started off with TRM probably when I moved to Miami during COVID, and I attended one of their, Eric's lectures. And I started off, I joined TRM, and then I started, following all their presentations and learned about a lot of the tools. I tried some worked for me, some didn't. Pitbull, as you mentioned, I used that very heavily. They just came out last week with, their own transcript monitoring that you could send out to clients, and they sign up for, a small fee, and every day of the week, it will log into the IRS for the clients that signed up and check for like 250 different alerts. Like, has your return been posted? Has the IRS sent out a notice? Has a lien been filed? Has a levy been filed? Has your return been selected for audit? Is there a penalty added? Is there an interest added? So many alerts that I didn't, I didn't even know about all these 250 alerts. And it's actually amazing that you could know before, months before, that the IRS is looking at your return, and before you even will sniff a notice. It's, you're talking about being ahead of the game. This is actually ahead of the IRS. I mean, they don't even know they're going to be, doing it.
Right, THS software does the same thing.
Yeah.
Yep.
It's kind of amazing. So yes, the toolkit's amazing. The marketing, TaxCure is amazing. So, are you ready to move on to the next topic,
Sure.
Patrick? So, do you want to talk a little bit about? I know it's one of your expertise. I've heard you do these lectures about divorce issues and tax resolution, and also tax planning. There's a lot to unpack there. How to prepare returns, what goes in between innocent spouse, injured spouse, returns that are filed joint and maybe in error. I've heard you talk about that. And then how it plays out in tax resolution space.
Sure. So one of the areas I work a lot with family law attorneys here in Indiana. I speak for the Indiana State Bar Association, Indiana Continuing Legal Education Forum. I'm beginning to work with the American Bar Association, and the idea of taxes and divorce, how to deal with divorce issues in tax. And my second book in the Break Free series was Break Free from the IRS, Taxes and Divorce, A Match Not Made in Heaven, available on Amazon.com. Which goes through the gamut of how to deal with tax issues in divorce. And now here's the key, is it isn't the attorneys that I'm necessarily wanting as clients, although I have attorneys that themselves are clients, but it's their clients I want as clients because they have tax issues in their specific ways to go through it. Now I have a full 8-hour webinar series I do on taxes and divorce, so obviously we can't go through all the ins and outs here. But Stephen's right, there are a lot of different aspects to deal with when it comes to taxes and divorce that need to be understood. Filing status. Two people are getting divorced. What filing status do they pick? You want to advise a family law attorney on. If the divorce is final before the end of the year, they can't file jointly. So if that's what their intent is, that divorce has to be finalized sometime in the next year. I had a client come in and she sat down with her settlement agreement, and she hardly made anything. I mean, pretty much she made like $4,000 a year, and her daughter gave her money. So she hardly had anything, and she owed about $20,000 in tax and a joint tax. Clearly, not only an offer candidate, but the offer was like $50. And she asked me, she goes, my attorney suggested an offer in compromise. What is that? So I told her about it. I'm reading through the settlement agreement, and the settlement agreement said, quote, once the divorce is final, the parties will file a joint offer in compromise, and it will be accepted by the IRS within 6 months. So two things. First of all, once you're divorced, you can't file a joint offer, number one. And number two, the IRS is not going to get an offer in 6 months. So they already can't follow the divorce settlement agreement. And that was my idea behind, let's start educating some of these attorneys when it comes to divorce. There are other aspects of it. If it's injured spouse versus married filing separately, or an innocent spouse case, what are the different aspects of an innocent spouse? And you work with the attorney to help craft the language for the settlement agreement. Now, the way I work is I'm not an attorney, so I cannot ever give legal advice or write any legal language. But I tell the attorney, in layman terms, this is what I think it should say. You guys do your magic and write it up and make it look all legal. And they respond well. But they're a great referral source. There are a lot of attorneys out there, they hate doing tax, and they're looking for tax advisors who can help them in this particular area. I've been brought in to testify in divorces. I've gone to mediations. I'm collaboratively trained in the collaborative divorce process and I deal with tax issues. It's a great way to grow your practice and build that referral base. Stephen did mention we had a client, she came in, referred to me by a family law attorney, and she owed about $23,000 in tax. And she was wanting to get a divorce. However, when she met with her attorney, the attorney said, well, you're not married. And so she was like, what? So they're like, well, you filed this joint return, but you have no record of you actually being married. What happened was they had gone to Mexico. They got married in Mexico, but it wasn't done legally in Mexico the correct way, so they weren't legally married there. Therefore, they're not legally married in the United States. But they filed a joint return, which is an unlawful return under the Internal Revenue Manual, 2515-1926. And so we have to then fight the IRS to say, hey, that joint return is unlawful. You need to set it aside, and then this is the return for her, and that's how we're able to get her out of owing that tax debt that's really applicable to her, quote, husband in full. Those are the things that that you're dealing with. You get these strange cases, but these attorneys are brilliant, but they don't deal with the tax issue, and they're always looking to bring people in. My book, Taxes and Divorce, A Match Not Made in Heaven, that absolutely goes into all the different aspects of tax resolution and how to deal with attorneys on that stuff. But if it's something that's a great place to grow your practice, if you're looking to do that, A, you can reach out to me. I'm more than happy to help you. B, you're going to really be able to get a lot of clients and help a lot of clients and build your reputation within the legal community and grow your practice.
No, that's amazing. So I didn't know that you actually testified in all these cases. I mean, you're definitely going to be my point guy for anyone that has issues. Because I know what I know and I know what I don't know. I mean, I do a lot of tax resolution, but if there's I've done innocent spouse before injured spouse, basic cases, but all these issues that you raised about whether the return was filed properly as married filing joint in the beginning, and then all the issues that go into divorce, people, of divorce attorneys are putting in, how this has to be resolved, and it's not feasible to, like you just said, if they're putting in that after the divorce they're going to file a joint offer and settle it within 6 months, and that's an impossibility.
Yeah. Well, one thing here, what's interesting is, so there's an interesting exception to filing head of household when you get a divorce. because the IRS, what IRS considers a custodial parent is different than what a family law attorney will consider custodial. The IRS considers custodial parent the parent who has more overnights with that child. And for head of household purposes, you have to have a in essence, a dependent. You have to be the custodian. The other aspect is you can file a head of household if you're divorced and you meet all the other requirements. But if you're getting divorced, you're not divorced yet, but you have not lived with the other spouse for the last 6 months of the year, you can still file head of household if that dependent has lived with you more than half the year. That's something I work with family law attorneys and make sure that gets put in the settlement agreement. So when we're doing the return, we can follow it and we work with them to help them. That's something few people even realize, is that yes, you can do head of household. And if there are 2 children, each can file head of household if they each take custody of one of the children for tax purposes. Just a number of overnights each year, they both can do that too. So these are the things that family law attorneys are looking to us to help them resolve.
Felicia, I remember, I think it was even this week or last week, you did a presentation about compliance. And one of the issues that you raised is, you said, when you file a return, if you're married, the default, if you don't even check the box, is married filing separate.
That's
you
correct.
actually have to elect to be in joint status.
Yes.
And a lot of people don't realize that. A lot of people think that married filing joint, because you're married, that's the default, and that's not. The default return filing status is married filing separate, and we have to elect to file jointly.
Which is why you can't file joint and amend to separate, because
That's
it's
right.
an election that you've made.
That's exactly right. You can always take separate and amend to file jointly because it's an election, but you can never take a joint return and decide, oh, I don't want to do this anymore, and we're going to file as separate. So yes, you're right. I did have that. We did have that presentation yesterday.
Yes, that was yesterday, right? Yeah, I knew it was like, sometimes days like mesh and weeks mesh, and when I'm working till like 9, 10 o'clock at night. But yeah, and that actually hit home with me, because that's something, as a practitioner, I didn't know that was the default status for married.
It sure is.
Oh, great news. Okay, I guess we're ready to move along to, I guess, a fourth topic. Bless you.
Excuse me. Thank you.
And this one, we're not going to spend a lot of time with, because I believe we're going to be covering it in detail in a couple of other topics today. But let's just touch upon it.
Excuse me. Sorry.
Bless you again. Client comes to us and they go, Mr. Cass, I owe more than $100,000. What are my options? I owe, and they go, I've been trying to contact the IRS. I can't reach them. I don't know what to do. I wanted to go on a payment plan on my own. No one will talk to me. Let's talk about all the options. Client comes and says, I owe the IRS $100,000. What do we do? I mean,
the first thing we're going to do, Stephen, as you well know, as practitioners, is we're going to go, okay, well, we need power of attorney, and we're going to pull transcripts. And we need to see those transcripts. We need to make sure that they are in full compliance before we even make that first connection to the IRS to start any type of resolution process.
yes, transcript number one.
Transcripts are always number one. Number two, if they're not in compliance, we need to get them in compliance. Because now they may owe more than the $100,000, or they may have, if they're within the 3-year time span, they've got refunds that might reduce. We don't know. We don't know the answers to these questions.
Yes, but if they come to us saying they know more than $100,000, chances are it is more. And I've always found it is more than $100,000.
It is more.
Sometimes substantially more. I'll get a client that says, I remember I owe $100,000. I owe transcripts, and I run them, and it turns out to be $170,000. Taxpayer goes, well, that's interest and penalty.
Right, exactly. I think that's what hangs up on most taxpayers, is that the client goes, oh, well, I owe $100,000. All they're thinking about is what the bottom line of the tax return was.
Right.
And the tax return's been posted and assessed, and they haven't done anything about it. And we're 3 years later.
Yeah. 4
Now
years,
we have
5 years.
the non-file, the payment penalty, and then all the interest that tacks up on top of that. And so there's just a lot to that, and it always equals out to be more. I have a client right now that actually, when they came to me originally, they wasn't sure how much they owed. They owed 1.9 million, and I just pulled transcripts again the other day, and they're over 2 million now with additional interest. So you see where it can easily mound up very fast.
Yeah, yes, it does. But once we pull the transcripts, clients and compliance, we all know what we could do. Number one for me, offer. Client qualifies, they pass the offer test. Best
Sure.
solution for me always will look at the offer. The only reason an offer won't work is if they have too many assets, or if they don't pass the budget test. And then we look at the installment agreement, which we're going to go into a lot more detail actually today. So I'm not going to go into the various installment agreements out there. There are a lot of them. We're going to be talking about them. But I always try, if an offer is tax-based compliance, if an offer works, that's my number one. Number two, installment agreement.
Mm-hmm.
Number three, for various reasons, if they qualify for it, C&C status, collection uncollectible.
Yes.
But those
Now-
are the way. First, again, pull the transcripts.
Right.
See if the client is in compliance. If the client is not in compliance, then you got to get them in compliance, or else our tool chest is very limited. So we get the client in compliance, and then we go offer, installment agreement, C&C.
And when we're looking at those transcripts, the one thing sometimes that clients don't realize too is that we're also looking for where can we reduce liability, first time penalty abatements, anything else out there that they are not understanding that they have that, because when they call the IRS themselves, the IRS is never going to offer up any source of penalty abatement of any kind. And so if we can work the case and reduce some of the liability by reducing some of the penalties, and what most don't realize is that when we reduce penalties, we also are reducing the interest that was tacked on with those penalties as well. So that
Yes.
can be quite significant.
Exactly.
Yep.
So again, these $100,000 cases, for whatever reason, I don't know why, that seems to be my expertise. I'd say out of 70% of the clients I get are over 100,000 to $1 million. I'd like to have the small ones. They're actually a pleasure to deal with. But it's funny, as I was just checking my email as we've been on this. I just got a client that says I owe 150,000 right now. What could I do? Same thing. Which
But then you'll also get those same clients that, just like I have a client that owes 2 million, and unfortunately they're kind of nonchalant about it, like no big deal. And what's really weird is when we pull transcripts that they're not in collections. But the concept here is my brain is that they have way too many assets. They're not an offer candidate. Their income is too high, they have way too many assets, and so not every client that owes 100,000 is going to be that offer, and not every just because you owe a lot of money doesn't mean that you're going to be an offer candidate because you have too many assets.
Again, that's my number one. That's my number one option. But if it doesn't work, I go down the list.
I seem to find in my world that the offer is always out the door because they have way too much income and way too many assets.
Yeah. It usually is, but sometimes, I've had clients that it's in that range that they do have a lot of debt, but they don't have any assets. So let's say they've used a retirement account to live on. They don't have a home. They used to make good money, and they were self-employed, but they haven't now been working for 2 years. Still working. I have, a couple in that range. So I get the gap. I get the clients that you said that won't qualify for the offer for a number of reasons. Other clients that have this debt now, but they're actually a perfect offer candidate.
Mm-hmm.
Yep. Like I had a client where he owes like $54,000. He has $57,000 in equity in his house. Doesn't qualify for an offer. It's already out the window. However, he had just retired, and his retirement pay is about half of what his actual pay was, and now, but he's currently not collectible, and there's only about 4 years left on the collection statute, so we put him CNC. He's now on a fixed income. His income's never really going to rise unless he wins the lottery. He'll just ride out the 4 years and get out of it and not have to pay anything. So, that's where you look at the other options there are to resolve it, because an offer was my first thought. Didn't qualify. What's the next step? CNC. That works, and it's going to have the same effect. He's not going to pay the tax. He's going to get out of it. So,
Yeah. Okay, let's move on. Another interesting topic, I get a lot of these, is a client will come and say, I owe payroll tax debt. I'm the responsible party for a company that owes payroll taxes. I'll first call I'll have with them is, I'll evaluate it. I'll say, yes, offers and settlements are possible. It is more difficult. It's hard, but I get them done. It's the same tests, but, let's talk about why is it hard. A lot of people don't know they do know, but maybe they don't know how serious. When you have payroll taxes, they're what's called trust funds. These are monies that you as the employer, company, are taking out of the employee's salary. You're supposed to put it in a separate account and then remit it to the government either weekly or bi-weekly or monthly, depending on, your payroll threshold. So you're holding this money. It's not your money. It's money in trust for, the employee's taxes that's being paid off to the government. That's why it's called trust.
That's the magic word. That's the magic word there, Stephen, is that you took the money out of your employees' taxes and holding in trust for them. So what have you just done? What's it called when you take something that doesn't belong to you and you don't do what you're supposed to do with it?
Fine.
Stealing. That's right. And that's exactly how the IRS looks at it. That's why
the IRS actually has a code provision. I'm sure you're familiar with Revenue Code 6672.
Mm-hmm.
Oh, yes.
Yeah. That says that they will now, when money is not remitted to them that's been held in trust for employees, under 6672, they will now look to the people behind the corporation and make what's called responsible party assessments.
And this is where sometimes, Stephen, that some business owners will tend to look and say, well, I can get hidden behind the corporate law or the LLC or whatever they're doing, and they think they're protected from an individual standpoint when really they're not, because as you just said, 6672 says, oh no, now we're going to go after the beneficial owners of the company that are responsible for this. And that could also be, bookkeepers beware.
Yes.
If you are in fact responsible for paying the payroll taxes and you don't do that, this could also fall on you as well.
Yes. Again, responsible parties by law could be owners of the business, depending on the percentage and the involvement in the business, where they were in charge of writing payroll, signing checks, doing payroll tax returns, control of the purse, control of the taxes. Those are usually people that are deemed responsible parties. But it could also be, doesn't have to be an owner. You could be the CFO, the treasurer. I've seen these, a lot with, businesses and, a treasurer or a CFO will come to me and go, hey, I was just doing the books. I was
but they had control of writing the checks and making the payments.
Yes, they did. And that's why the IRS will go after them.
And small businesses can even have a bigger problem, because it may be an office manager who happens to be in this role. This isn't what they do, but they do it, and they're told they just follow what their boss tells them to do and delay the payments or something, but they're the ones that make it. They could get roped into this and not even have any clue that they are.
Exactly.
So the IRS will make, responsible party assessments under 6672. Responsible parties can, if they believe they're not responsible, can contest it. There are a number of factors that go into this. I've seen these before. I've seen these cases. I usually don't get involved in this stage. I get involved in the settlement, which we all know about the options. To me, I've done a lot of offers. Again, they are harder than an income tax offer, but I get payroll tax offers done plenty of times. Again, if the client personally, I know what he did, but they look at his current financial status. If he doesn't have money, the IRS will hold him to a higher standard in terms of the offer. They are more difficult. They will be looked at more scrutiny. But I get plenty of payroll tax offers done if the client really does meet the offer test. Do you get them done too?
I've gotten them done, but I think it's been more so because the business is shut down. There's funds. There's nothing there for them to come after beyond the individual.
If the business is still active and you want to try to reduce it there, it's going to be very, very, very difficult.
It is difficult.
Yeah, the business
because
has
the IRS says if you did it once, why would what's going to perpetuate not to do it again? And it's just that it's the nature of the beast in the concept of tax law that says, hey, you took. This is stealing, and stealing is against the law no matter how we look at it.
Right. But again, the operative word is it happened. Client comes to me, of course, after the fact. If they meet the test, I'll look. Yes. I'll tell them I'm going to do a full-blown interview with you. This will be getting more scrutiny. I have done payroll tax offers and compromise. You do qualify. The IRS will be looking at everything. You better be very honest in your presentation. Disclose all your bank accounts. Or if the properties that you owned within the last 3 years and you sold them, the IRS is going to be aware of that. And that they may want to account for that in terms of the settlement. That's why I'm saying that I get payroll tax offers done, but the IRS will be looking at that more than an income tax case.
Mm-hmm.
And the other thing is, you might have to have a come to Jesus moment with the client and let them know that this business may not be a going concern, and have that tough discussion going. Maybe it's not, the business may not be able to survive if it's an ongoing issue. And that's a tough conversation to have, but it's one that as an advisor and a planner, you're hired to provide them, advice. And that may be the advice to have as well.
Yeah, and I'd say that is the advice that I do give. I mean, if a business has lost money for 3 years straight, and a client comes to me and they'll say, Mr. Cass, I didn't do anything wrong here by not remitting the trust funds to the government. The business was losing money. I needed to pay the employees. I wanted to make sure my employees got their paycheck. I needed to pay my rent. And there's an expression that they use. I'm sure you've heard this before. I'm robbing Peter to pay Paul.
Yeah.
So I'm not using the money themselves. I haven't taken a salary in 3 years. I'm trying to do it right by everyone. Well, that is noble. That's great that they're taking care of the employees, they're taking care of the landlord and their suppliers. But when you say you're robbing Peter to pay Paul, well, Peter, which is technically the IRS, because it was the trust fund monies that was taken out of the employee's paycheck that was not sent to them, they're not happy about this.
Right.
Yeah, so it's like poking the bear. You can only poke the bear so long before the bear gets angry.
Mm-hmm.
So I agree with you. I mean, I get payroll tax offers done. I settle a lot of trust fund offers, but more scrutiny. That is the operative word. More scrutiny. They can get done.
I think you might have a better chance on an offer if the business is closed.
Yes.
I'd say,
and getting it done that way versus if it's an ongoing business and they're going to, because it's just going to be a continual.
No, I agree with you. In fact, personally, I wouldn't even take on an offer if the business is still ongoing, because in the past I've tried those. Those are almost, when you say, payroll tax offers alone or more scrutiny, if you have an ongoing business, I'm going to tell the client, quite frankly, this is almost impossible. Because the IRS will say, why am I giving you relief? Why am I giving the business relief if you're going to continue in business doing the same thing that you did?
Exactly.
Yep.
Exactly. I agree.
Yeah. Okay, so let's move on to the next topic. This is, one of my main businesses. Say last year, I've been getting a lot of sales tax cases, and as we just talked about, this is actually very similar to what we just talked about payroll tax offers with the IRS. Sales tax for New York State is also a trust fund. This is actually, and this the difference here is a company collects money. A retailer, a seller of products, a restaurant, they collect money, and they charge extra money on top of their money for sales taxes. So they collect the sales, and then they add on a sales tax amount. That amount should have been, if they're doing proper accounting, held out in a different account and remitted properly when you file your New York State sales tax return. Again, those are similar to payroll taxes with the IRS. These are also trust fund taxes. So I get a lot of those, and when to me, you start off. This problem could be a lot easier if the clients would do a couple of basic things. Number one, hire the right compliance people. Now, even let's say there's a business that they're collecting the money and they don't have it right now. They've used it, they've lost it. Like the business is losing money. It could be a restaurant that didn't do well during COVID. But the worst thing they can do is not file returns. Decide, say,
Right.
Hey, I don't want to let New York State know that I'm behind, so I'm going to not file for a year or two. Oops.
Well, let me ask you this: does New York
Yeah.
will New York file a kind of guesstimates of what they think it would
they
be
will.
then?
That's what I mean. As the IRS will make substitute returns, New York State will now do an estimate return if the taxpayer doesn't comply within a reasonable period of time. And these amounts could just be industry average, what they think it should be. And I've seen these before, and it could be a business that truly, because they didn't do well during COVID, made little, in terms of sales. But New York State will come to their own estimate, and now you're locked into the estimate. Those are very difficult to contest. So the operative word is you file your returns. File. Even if you can't pay, you file. Of course, if you have money and it's segregated, you should pay it. But if you don't, you file it.
I think that's to be said. I don't mean to talk over you. I apologize. But Patrick, I think that, or Stephen, I think that's to be said for any state. If you're filing sales tax returns and you're paying sales tax in that state, file the returns. At least let them know that yes, you do realize that you're acknowledging the concept, and you don't have the late filing penalty on top of that. But it's with any state. I don't think, I know that you work a lot with the state of New York, and I know they probably are maybe a little bit more stringent than some, but all states have kind of the same caveat issues when it comes to sales tax and not being paid.
Yeah, I'm sure they do. And they do it for a reason. I mean, I'm sure every state has sales tax, and they treat not paying that, pretty harshly. But in terms of New York, what I see is get your returns filed, even if you can't pay. Of course, then what you should do is engage the New York State early and try to work out a plan or do an offer. If not, New York State has the gamut of their tool chest, like the IRS. They don't file a lien; they file what's called a warrant. With this warrant, they go, Steve, am I under arrest? I go, not right now. Just means that this is a lien. a lien.
Not yet, as the
That's
word
all it
says.
is.
Not yet.
But
Right.
but
And,
in
and
terms of,
Indiana will turn you over to collections in a heartbeat too, and they have the teeth to collect. When the IRS turns you over to collections, they just harass you for a little while. But the state will turn you over to
yeah,
collections in a
IRS
heartbeat.
collections is honestly, we could talk about this in another video. But IRS collections, I never deal with the private debt collectors.
Right.
There's no
So the
point to them.
question I would have, and I don't know about both of your states, I know in the state of Missouri, they not only turn it over to collections, they actually send it to the county collector and say, here, they owe us this money, and they will send a prosecutor out. They will send a warrant out to your address. And they send it
Yes.
over, they put it to the local prosecutor's office to be, for like small claims or whatever it is. But it hits the
Yeah.
prosecutor's office. Now you've got to deal with them.
Yeah. Well, in New York, they don't do that, but they do file this warrant. And again, it's not an arrest warrant, it's a lien. But what this warrant does is similar to the IRS. You know, we're all familiar with letter 11, right? Which means, IRS sends out a notice of, intent to levy and do all these, nefarious actions. New York State will file a warrant. They file a warrant, guess what? There's no notice of intent. They could now, once the warrant is filed, they could levy corporate bank accounts. They could actually go to the business and padlock it if they believe it's a business that should be shut down. They could levy income. They could also then, if they don't like the business and they really want it shut down, they could revoke their license to sell. So they could, the warrant, comes and then you don't deal with it. And then, similar to, I'm going to tie this all together, similar to the IRS and trust funds, they now will make, responsible party assessments against the people. So they're going to come to them and go, okay, the business, we've given the business a lot of time, we've warranted it, the business didn't pay, now the business is shut down, we've closed it down, that's great, we got the business gone, now we're going after you. And now it becomes, something that they come to me and I'll deal with it, a number of options, and we could actually go into that within the next topic, which is, New York State programs. They have a lot of different options. They have an offer program, very similar to the IRS, just a couple of different wrinkles. Their offer program means that, they also have an asset test, a budget test, but they actually have a third test, which means if you filed an offer any time in your life and you defaulted on it, you can never file an offer again. So that option is one and done, which means I come to a client, I'll put this in my fee agreements. I'll tell them point blankly, and I'll make them sign this. If we do this offer and we work out an agreement that New York State proposes in settlement, and you agree to that, and that you can make these payments, and you sign this, and then you later default, that to me means that you can never file an offer again. So if we're in negotiations with an offer and it is not going well, what you should do is withdraw it. No harm, no foul.
Right.
You should never, so that's the big thing that they do.
Might as well save that offer for a day when you know it can be utilized and be used,
it could be,
instead of wasting it on one that you know is going to fall apart.
Right, exactly. Like the IRS, on the other hand, does not have that. You could file a lot of offers. I wouldn't say file 100 of them, but 3, 4, reasonable. I've seen them. Sometimes
Kind
I've
of
seen
like
a client.
bankruptcy, if you wait every 7 years, you can probably do one every 7 years, kind of, something to that effect.
Exactly.
You see where I'm going? You can do it more than once, where you're stating that the state of New York
New York one and done deal. So again, a lot of clients, I do a lot of New York and New York City offers and compromises. I deal a lot with the Department of Finance. I'll get these done. I know the rules, but the client needs to, if they can take the deal that I worked out for them, it's usually a good deal. but they got to make sure that they can pay it, or they need to like withdraw and fight another day. But New York State has other options, just like the IRS. There's installment agreements. Now, the difference between New York and the IRS is, New York, and we're going to talk about installment agreements a lot more with the IRS, I believe, in a moment. So we could get into that. But New York State agreements only go up to 5 years. There's no partial pay. So the problem is, if you don't qualify for an offer, let's say you owe sales taxes of $1 million, and I could work out a deal to settle for 40% of that because it's trust funds. New York State has a higher standard than the IRS on trust funds. If you can't pay the $400,000 over 5 years, well, then the other option then is do an installment agreement. Now, same thing. That now you're back to the full thing. I can't pay $1 million over 5 years either. Taxpayer will say, and they can't. So New York State doesn't have a partial pay or a non-collectible status per se. They have what something, and this only comes into play when New York will restrain someone's driver's license, which is going back to our first video. That's similar to the IRS pulling the passport. New York State will go after the driver's license if you owe more than $10,000, and that's to get the client compliance. But the difference is, if you don't qualify for the offer, which is why I always try to do the offer, the installment agreement, if the amount is so large, you cannot get into an agreement. There's no partial pay agreement. The only thing you can do is apply for what's called a restrictive driver's license. Say, in New York, I need it for work. They give you, okay, you could drive to go to work only. And for certain medical reasons. But they put a restriction. Again, I don't know how they enforce that, but that's why, operative word before we move on to our last topic is, similar to IRS, did not let it get to that stage. File your returns on time. That stops the interest and penalties. Don't let the IRS don't let New York State make returns for you, which we was talking about in the sales tax case, because that could be catastrophic. File your returns, even if you can't pay. Try to work out an agreement early, and get ahead of the game. So, without further ado, I think we've reached our last topic, and this will be talking about various IRS installment agreements. As you know, there's what's called a short-term payment agreement. There's what's called a streamlined agreement. There's a non-streamlined agreement and a partial pay agreement. Felicia, Patrick, you want to go into some of these?
Sure. One thing with the streamlined installment agreement, and this is I work with clients, and it's still kind of iffy on what the dollar amount is to get into a streamlined installment agreement. But the great thing about a streamlined installment agreement is you don't need to provide the 433, so you don't need to disclose your assets. You can say, hey, we can take it out to 72 months. I generally tell clients if it's below $50,000, they can go out 72 months. And we don't have to provide the assets, which is important because if they have $250,000 in their retirement account, and the IRS requires them to file a 433 to disclose that, they may say liquidate the part of the IRA. It helps protect assets. So if a client comes in and owes $62,000, I say, can you pay $13,000 now to get it below $50,000? Then we get you into a streamlined agreement, and now we don't disclose those IRAs or those 401ks or some other asset, and you can then just pay it off and then be good. That's the beauty of the streamlined installment agreement. But sometimes clients, if they owe $351,000, I'm working on a client right now that owes $351,000. There's no way that they can get below that, so we got to do a full, regular financially verified installment agreement with the whole 433 and run the whole gamut. But if they can get below that threshold, it's imperative and behooves them to do that because it can really help protect those assets.
So you're talking about $350,000 case. So the $50,000 case is pretty simple. The streamlined, works,
Yes.
you don't have to disclose anything, 72 months. Let's say you have 250,000, not 350, 250. Talk about the non-streamlined agreement.
So the non-streamlined agreement is basically we're covering it over depending on the CSED, the life of the collection expiration dates. But so we're also looking at income versus expenses and what the bottom line of their ability to pay is. And that there begins and says, okay, maybe we do a partial pay agreement to where we say, okay, if you can't afford to pay the whole thing, this is what we can afford to pay over the life of whatever the IRS says it should be. So, but again, we've got to do that 433. We have to disclose all assets. We have to disclose all expenses. We have to document them. You have to have 3
We're
months.
talking about even in the non-streamlined, without, I'm not talking about the partial pay. Because I agree with you. Technically, there should be a non-streamlined agreement where you should be able to get into an installment agreement under $250,000 under the CSED, which is the collection statute remaining for the IRS, without full disclosure. On the other hand, I've seen, because I get a lot of these high value cases, the IRS will still require 433Fs.
And that's where I'm going. Even though the IRS is saying, hey, they're under 250, we don't need all this. You still need all of it because the IRS may still want it because you have to be able to support the information on the 433F.
Yes, and I've done those, but I agree. You have to still. I'm tell clients you're going to be showing. The only way you get out of showing financials is to get to 50,000 or under this the streamlined agreement over 72 months.
Exactly.
So let's talk about my favorite actually, because I don't know why I get these, but I get so many of these partial pay installment agreements.
So
Patrick, you want to talk about them?
yeah, a partial pay. So when I first learned about it, I always thought, well, why isn't that just an offer and compromise? Because I'm paying less than what I owe over the statute, that sort of thing. There is a difference between the two, and a partial pay is basically this: you do the financial analysis, and then you see, okay, here's my revenue minus my allowable expenses. Because with the partial pay, they're going to be much less flexible on your expenses. You subtract your allowable expenses. Here's my monthly amount of disposable income each month, and you take your equity and assets plus that disposable income. This is what I can pay each month. And that's what the IRS will require you to pay, and you pay it until the CSED runs out. And you're not going to full pay it. That's why it's a partial pay, but it goes for the full gamut of the collection statute.
That can go longer than 72 months is what we're saying.
But they will also periodically revisit your financials because they want to make sure that, hey, you just got a new job where you made an $80,000 raise. Hey, now you can be a full pay or something. Or if you just won the lottery, you can pay it all off now or some things like that. They will review those. But a partial pay is effective. And here's the other thing. What's interesting is sometimes I have a client where I did the financial analysis, the RCP analysis, and technically they would qualify for an offer and compromise on 2 of the 8 years that have a balance. But a partial pay installment agreement would actually pay the government more than what they would get paid under an offer. And so the government would most likely deny the offer and say do a partial pay because it's not in the best interest of the government to accept the offer if a partial pay could yield them more money. They're still not full pay, but the partial pay is an option against, in that particular case, against an offer and compromise. But it's a great way to get somebody into an installment agreement because people think, oh my God, I owe $200,000. I can't pay the $18,000 a month. I'm making that number up. I can only pay $1,000 a month. Okay, they'll take that. And you'll pay that until the statute runs out, and then they'll write off the rest. But they're going to be very stringent on their expenses to arrive at how much you can
Yes,
pay.
I agree with you. Um, as I mentioned, I seem to be getting a lot of these more than I like to. And the way I look at it is, I think you described this, partial pay installment agreements is kind of like a back door into an offer. Because at
Mhm.
the end of the day, you're going to be settling. It could be revisited in the future if you're making a lot more money. So it's not but assuming you're at the same income level as when they agreed to it, it's a backdoor into an offer. It could be a really good deal. My problem as a practitioner is these things take a long, long time, especially for the high
Yes.
value taxpayers. Um, I'd say anywhere between 150 to 250, which is again my specialty. Uh, I'm dealing with the IRS ACS special procedures, and I find I'm pretty much every month, I'm calling them up. I'm talking to an agent. That I go through that, and then they go, okay, I see what you provided over the last couple of months. Um, my manager has reviewed this. We now want X, Y, and Z. So say I provide X, Y, Z. I call up. They go, okay, now we want, ABC. I have one partial pay installment agreement for $200,000 for a husband and wife that I've been working on for a year. Literally, I've, I quoted the taxpayer a flat fee, which, is what I do for these. I thought I could get it done 2 to 3 months, reasonable. It's been a year. I mean, some of that got delayed to the IRS shutdown, but it still hasn't been concluded because the IRS, now it's in appeals. Of course, they actually at one point they tried to send a letter 11, even though I was in negotiations. So I'm dealing with an appeals officer right now on this, but this case is still going on. Meanwhile, the taxpayer in 12 months hasn't paid a dime, and I've held off the taxpayer getting a lien. And again, it's a $200,000 case. So the taxpayer is pretty happy that they've not been paying everything for a year, and they have no lien against them. And I've held off the IRS. But my opinion is, I'd like to conclude these things within a couple of months. You know, but I really have no control. I mean, you deal with the IRS when you engage them. You give them the 433Fs. You give them what they require, but you have no control of what they're going to ask for because when they approve this, the reason why they're taking time is they know because right now the taxpayer I'm talking about, their financials over the last year have changed drastically. And one of the taxpayers' husband and wife lost their job, so he's zero, and he probably won't be working again. He's on disability now, so they
Mhm.
now are almost negative, almost like CNC status. So originally we were proposing them like $1,000 a month on this $200,000 debt. Now, because the IRS's delay in accepting that, my opinion, they're perfect CNC status.
And I would try that. I
Yes,
definitely would try the CNC
which I
status.
am. That's what I'm dealing. I have an appeals officer that I'm dealing with.
But the CSED tolls when you're in a payment plan. So once you file it, the CSED is stopped, and so
Yeah.
it's delayed for that year. That's told that statute. It's not running, and if they were close to the expiration date, that's where it could get. You have to take that into account too.
But these, partial pay installment agreements, just keep in mind, we're letting taxpayers know and letting our fellow practitioners know they're doable. There's a back end door to an offer. But from my experience, with these, let's say, 150 to 250,000 cases, how long, Felicia and Patrick, how long does it take you to conclude these?
12 to 18 months at least.
Oh, I was gonna say, I've got one right now that I've been working on for a year and a half, 18 months. Yeah,
So
and
you're saying the
it's
same thing that I'm
not
saying.
even close.
The same thing I'm saying.
Yep. They're taking a long time, and I'm not sure really why. I think it would be really nice if we, as practitioners, had one person that when we started talking to that one person, that we could continue to talk to that one person. But unfortunately, what happens is we talked to that one person, and then when you call back in, somebody else has to look at the case and review it, and they're like, oh, okay, well, we, as you said, we see what happened, now we need XYZ, and then, you know, you send that in, 2 weeks later, you call back, oh, yeah, well, we see you, now we need ABC, and it's because somebody else is always looking at something different.
Exactly. Which is why right now, in my case, that I have an appeals officer, I have one-stop shopping.
And that makes a big difference. That makes a huge difference. If we could get somebody like an appeals officer on every case, we'd have it made.
Mm-hmm.
Yeah. But unfortunately, unless, you know, the IRS does something, when I say does something, I'm talking about letter 11, because that's the only thing that will engage an appeals officer. Then you really can't just say, I want an appeals officer. You know.
I agree. I'm just saying that it would be nice if the IRS and Congress could implement something to where there were more agents out there that we could, you know, or if we talked to somebody on the phone, we could call back and talk to that same person. Because when you're dealing with the same person over and over and over again, you have a better, you both have a better understanding of what you're doing.
Oh, I agree. That to me is common sense. Next time I'm talking with Mr. Trump, I'm going to mention it. You know, listens to me.
You just go ahead and do that.
Yeah, but the bottom line is, you know, for our audience, these, you know, IRS installment agreements, IRS payment plans, they work. There's a lot of options. There's, you know, there's a couple depending on the circumstances. They work. They will get them in compliance. And meanwhile, while we're in it, collections on hold, as I've shown from my example. So.
Well, I think with that being said too to the audience, if you're not a practitioner and you're an individual that is sitting in this situation, you said the right thing. They do work, but we also want them to understand that they do take time to get resolution.
Yes,
it's not just happening overnight. Some people think that we have this magic ball and we can just pick up the phone and instantly get something resolved, and it doesn't work that way. I had somebody ask me that last week, hey, you can get this done next week, right? And I'm like, no. We're not gonna get anything done in a week. Maybe get the power of attorney processed.
I mean, you know, it used to be when I was, you know, doing bankruptcy, there are things you can get done in a week. Like, you know, I could call, or used to file bankruptcies, and I used to call up friends at, you know, at the DOJ or, you know, the Attorney General's office and work out a deal. Say, hey, you know, we owe $1 million. You know, as you could see, this client doesn't have the ability. You want to keep them in business. You know, we'll settle for, you know, $150,000. David goes, yeah, Steve, fine, let's paper it up. But
it doesn't work that way, though.
To me, it was back in the day. These were like, you know, practitioners that were around before me that have since been retired. They no longer do that. You know?
And now you know why.
Right.
But, you know, again, concluding, there were all a lot of tool chests. We covered a lot of topics today. Do you have anything to add? I think we reached the conclusion of, you know, scheduled topics.
I think this has been amazing, and I think that we're providing a lot of information, and for those that are listening, to really inhale what we're saying and to understand why we think it's important to hire a professional, especially if you're not the practitioner. If you're the practitioner, we've given you a lot of tools to put in your tool chest. You now have the key to the workshop, whatever, and however you use that key is really up to you. If you are an individual that owes or a business that owes, we're here to help, and hiring a professional is always probably your best approach.
Completely agree.
I agree. Okay, I'm going to stop the recording.